Welcome to DF Markets Money Management, Part 1. Many new traders believe that the key to success in Forex trading is finding a winning strategy to follow. However, without correct money management, a winning strategy can very easily turn into a losing one. The objective of money management is to strike a balance between risk and reward that gives the trader longevity in the market, while also allowing them to profit sufficiently to grow their accounts and scale up their trading. Core focus of money management is position and risk reward. Position sizing. Many new traders make the mistake of focusing only on the upside. So with that in mind, many new traders will often risk inappropriate amounts on a trade in order to try and amplify their gains. For example, a trader might think that if they risk 5% on a trade and they double their money, then they have immediately made 10%. However, in this scenario, the trader is not thinking about the other side of the equation, which is the loss that they will suffer if they are wrong and how that will affect their longevity of their trading. If a trader risks 5% per trade, it will only take 20 consecutive losing trades to wipe out their account. And this is not a huge amount of losses, especially for a beginner. However, if the trader only risks 1%, it would take 100 consecutive losing trades to empty their account. This creates a far higher likelihood of staying active in the market, recovering losses, and avoiding crashing your account. Key to position sizing is using the correct lot size. Lot sizing. There are 3 basic lot sizes to be aware of. A standard lot, which equals 100,000 units of a base currency, a mini lot, which equals 10,000 units of a base currency, and a micro lot, which equals 1,000 units of a base currency. The minimum trade size is 1 micro lot, which means that, for example, in EUR/USD, each pip would be worth 10 cents, so 100 pip stop would be risking $10. Whereas if you use a lot size of 10, which would be a mini lot, you'll be risking $1 per pip, meaning a 100 pip stop loss would equal $100. Finally, if you're using a lot size of 100, which would be 1 standard lot, you'll be risking $10 per pip, so 100 pip stop loss would equal $1,000. So you can see it's very important to make sure that you use the correct lot size to ensure your position sizing is correct. So if you have a $1,000 account and want to risk $1 per trade on a 100 pip stop loss, you would use a lot size of 1. If your stop was 50 pips and you wanted to risk 1%, you would use a lot size of 2, which would be 20 cents per pip times 50 pips, which would equal $10. Risk reward. The key to striking the correct balance with your money management is understanding risk reward. Only risking 1% per trade may seem incredibly low. However, if you have a positive risk reward, you can be extremely profitable. If you have a risk reward of, say, 3 to 1, this means that for every 1% you risk, you make 3%, which means that you can still make fantastic gains on your account while keeping your risk low. Risk reward is an incredibly important concept that many new traders often overlook in favour of hit rate, as they mistakenly believe to be successful they need to win as many trades as possible. However, a positive risk reward is far more advantageous. Compare these 2 examples. Trader A has a strategy with a 1-to-1 risk reward and wins 60% of the time. This means that over 100 trades, the trader would roughly have a 20% return from 60% of wins minus 40% losses. On the other hand, Trader B has a strategy with a 3-to-1 risk reward but only wins 40% of the time. This means that over 100 trades they would roughly have a 60% return from 120% wins and 60% losses. So even though the first trader has a higher hit rate, the second trader is far more profitable because he has a better risk reward.